Take a highly successful civil rights law firm based in Atlanta, Georgia. A practice like this routinely generates over $2 million in gross annual revenue. The attorneys running these firms operate in a high-stakes environment where their legal expertise is paramount. Because their focus is heavily dedicated to navigating complex, historically weighty cases, the actual business operations of the firm often default to whatever is easiest to set up. For most solo practitioners, that default is a single-member LLC. It is simple to establish, but at $2 million in revenue, it becomes a massive financial liability. Look at the cash flow of a single-member LLC. All profit passes directly to the owner's personal tax return, pushing the attorney into the highest marginal income bracket of 37%. On top of that, they are hit with the self-employment tax, draining roughly $95,000 right out of the firm's net earnings before a single wealth-building asset is acquired. The Internal Revenue Service knows exactly where this vulnerability lies. Armed with new enforcement funding, the agency has deployed thousands of agents to specifically target high-earning pass-through entities and sole practitioners. Running a $2 million practice as a disregarded entity traps the owner. Every dollar of active business revenue is taxed immediately as personal income, leaving minimal capital to scale the firm or build actual net worth. Escaping this trap requires separating the individual professional from the entity paying the taxes. This begins with a membership interest transfer. The attorney sets up a new C corporation to act as a holding company. They then transfer 100% of their law firm LLC ownership into that new corporate umbrella. Operationally, the law firm itself doesn't change. Because the LLC remains the same legal entity, it keeps its original employer identification number, its bank accounts, and its operational history. To the IRS, the LLC simply becomes a disregarded subsidiary of the new corporation. The tax liability now moves upstream. Instead of individual pass-through rates reaching 37%, we need to legally move capital out of the high-tax law firm environment and into other entities owned by the holding company. The legal mechanism for this is Section 162 of the Internal Revenue Code, which allows a business to deduct all ordinary and necessary expenses paid during the taxable year. Instead of outsourcing to third-party vendors for critical services, the holding company capitalizes its own specialized sister companies to do the work. The law firm pays these subsidiaries directly. First, a proprietary technology development subsidiary charges $250,000 to build and maintain a custom intake application and secure client portal for the firm. Second, a facilities management franchise handles specialized daily sanitation for the firm's offices, creating a $60,000 annual operating expense. Next, a fractional CFO subsidiary executes deep-level accounting and tax architecture, billing the firm $100,000 for the strategy. Combined with additional minor vendor contracts, this architecture legally siphons $500,000 out of the law firm. It is written off as a fully deductible operating expenditure, instantly converting into captured corporate revenue for the broader holding company ecosystem. While technology and service subsidiaries absorb cash, physical real estate converts that cash into a true wealth multiplier. To manage this, the holding company establishes a dedicated real estate subsidiary. This new entity purchases commercial properties with a specific mandate to serve as the physical satellite offices for the law firm's national expansion. The law firm then signs a commercial lease with its sister company, making regular monthly rent payments for the office space. Every rent check is fully deductible for the law firm. Simultaneously, those payments service the mortgage on the commercial property, building hard equity within the holding company's portfolio. By isolating the real estate in its own LLC, the structure physically separates premises liability from the firm's core intellectual and digital assets. This engine takes the active labor income generated by the attorney's legal work and transforms it into tangible, appreciating physical assets, all without the capital ever leaving their control. Generating new rental revenue inside the holding company could trigger its own tax liability. To neutralize that, the architecture relies on accelerated depreciation. The primary tool is a cost segregation study. An engineering firm analyzes the property and reclassifies specific building components to significantly shorter depreciation lifespans. Instead of depreciating the entire commercial building over 39 years, items like specialty fixtures, flooring, and renovations are separated out. Under Section 168K, The cost of these short-life assets is heavily front-loaded into the early years of ownership. This creates a massive depreciation expense on the real estate subsidiary's ledger, generating severe paper losses for the tax year. These are entirely non-cash deductions. The property itself hasn't lost actual market value, but the IRS recognizes a severe loss on paper. Because these severe paper losses occur within a fully integrated subsidiary, they form a massive tax shield ready to be deployed against the revenue generated by the rest of the corporate ecosystem. To see how this architecture functions in total, look at the consolidated holding company. Under IRS consolidation rules, the activity from every subsidiary flows up and merges at the holding company level at the end of the fiscal year. The math works systematically. The original $2 million in active law firm revenue is first offset by the $500,000 in business-to-business subsidiary deductions. Next, the massive paper losses generated by the cost segregation study on the real estate are applied against that remaining active revenue. The net result drives the holding company's taxable income down to zero. The capital hasn't vanished. It has simply migrated out of a highly taxed operational account and into wholly owned technology, service infrastructure, and physical real estate. The architecture neutralizes the corporate tax liability on paper without reducing the owner's actual net worth. With the capital safely captured inside the holding company, the individual owner must still extract it legally and efficiently for personal use. The holding company begins by paying the owner a direct, defensible W-2 salary, scaled to meet IRS requirements for reasonable compensation. Any additional capital the owner requires is distributed from the holding company in the form of qualified dividends. This creates a profound tax arbitrage. Instead of paying a 37% marginal rate, qualified dividends are taxed at preferred capital gains rates, capping out at 20%. Operating at this level requires precision. Every business-to-business transaction, lease agreement, and subsidiary service must have true economic substance and ironclad documentation to survive IRS scrutiny. When executed correctly, the professional moves past simple tax compliance and establishes offensive structural superiority. You stop paying maximum taxes on raw billing. Instead, you engineer a multi-tiered corporate ecosystem to serve as the grand central station of your wealth.